Hello students, welcome to the lecture on marine insurance, and after this lecture we will be able to learn the following objectives. Explain the marine insurance business and its types. Describe the principle of indemnity in valued marine policies. Define the essential elements or principles of marine insurance. Discuss the subject matter of marine insurance. Explain the warranties in marine insurance and operation of marine insurance. Understand the procedure to insure under marine insurance. Let us start with a brief introduction to marine insurance. This is the oldest branch of insurance and is closely linked to the practice of bottomry, which has been referred to in the ancient records of Babylonians and the Code of Hammurabi way back in BC 2250. Manufacturers of goods advanced their material to traders who gave them receipts for the materials, and a rate of interest was agreed upon. If the trader was robbed during the journey, he would be freed from the debt, but if he came back, he would pay both the value of materials and the interest. A contract of marine insurance is an agreement whereby the insurer undertakes to indemnify the insured in the manner as and to the extent thereby agreed against the transit losses, that is to say losses incidental to transit. A contract of marine insurance may by its express terms or by usage of trade is extended so as to protect the insured against losses on inland waters or any land risk which may be incidental to any sea voyage. In simple words, the marine insurance includes a. Cargo insurance, which provides insurance cover in respect of loss of or damage to goods during transit by rail, road, sea or air. Thus, cargo insurance concerns the following: export and import shipments by ocean-going vessels of all types, coastal shipments by steamers, sailing vessels, merchandised boats, etc., shipments by inland vessels or country craft, and consignments by rail, road or air, and articles sent by post. B. Hull insurance, which is concerned with the insurance of ships, hull, machinery, etc. This is a highly technical subject and is not dealt in this module.
Hello, I'm Benjamin Lupu, Certified Financial Planner of Kensington AMI, Registered Investment Advisor, with our next topic: how does marine insurance work? In this topic, we're examining commercial marine insurance used in the shipping industry. Insurance for small pleasure craft is a different topic. Shipping companies moving cargo from one port to another need to insure themselves against claims resulting from harm to their freight, crew, passengers, and any damage caused by their vessels to marine infrastructure such as bridges and harbor facilities. The ships themselves are insured by separate policies known as hull insurance, which cover losses due to fire, sinking, stranding, or collision with another vessel. This type of insurance usually covers both vessels in case of a collision. When it comes to cargo, shipping companies need to select how much coverage is needed. Some types of cargo need more insurance than others. Insurance for commercial vessels can fluctuate in price substantially due to variability in weather patterns, piracy, and other factors. Insurance is a major cost item for shipping companies, and a spike in insurance rates can affect their profits considerably.
Let us talk about marine insurance business and its types. A contract of marine insurance is an agreement whereby the insurer undertakes to indemnify the assured in the manner as and to the extent agreed against losses incidental to marine adventure. There is a marine adventure when any insurable property is exposed to maritime perils, that is, perils consequent to navigation of the sea. The term perils of the sea refers only to accidents or casualties of the sea and does not include the ordinary action of the winds and waves. Besides, maritime perils include fire, war perils, pirates, seizures and jettison, etc.
Hello, Garys here. Today we have an interesting topic: why you need boat insurance. Some people simply overlook boat insurance. They think that nothing bad is going to happen, when in reality, bad things often happen involving boats. If you own a boat, you need boat insurance. In fact, many states now require boat owners to carry watercraft liability insurance before they transport or operate a boat. If your boat has been financed, your lender will almost always require you to carry full coverage boat insurance. Again, most people don't think anything bad will happen, but bad things do indeed.
There are some types of marine insurance. A. Special declaration policy. This is a form of floating policy issued to clients whose annual estimated dispatches, that is, turnover by rail, road, inland, waterways exceed INR 2 crore. Declaration of dispatches shall be made at periodical intervals and premium is adjusted on expiry of the policy based on the total declared amount. When the policy is issued, sum insured should be based on previous year's turnover or in case of fresh proposals on a fair estimate of annual dispatches. A discount in the rates of premium based on turnover amount, example exceeding INR 5 crore, etc. on a slab basis and loss ratio is applicable. B. Special storage risks insurance. This insurance is granted in conjunction with an open policy or a special declaration policy. The purpose of this policy is to cover goods lying at the railway premises or carriers' godowns after termination of transit cover under open or special declaration policies but pending clearance by the consignees. The cover terminates when delivery is taken by the consignee or payment is received by the consignor, whichever is earlier. C. Annual policy. This policy, issued for 12 months, covers goods belonging to the insured which are not under contract of sale, which are in transit by rail, road, from specified depots, processing units to other specified depots, processing units. D. Duty insurance. Cargo imported into India is subject to payment of customs duty as per the Customs Act. This duty can be included in the value of the cargo insured under a marine cargo policy, or a separate policy can be issued, in which case the duty insurance clause is incorporated in the policy. Warranty provides that the claim under the duty policy would be payable only if the claim under the cargo policy is payable. Increased value insurance. Insurance may be goods at destination port on the date of landing if it is higher than the cost, insurance and freight, CIF and duty value of the cargo. In a contract of marine insurance, the insured must have insurable interest in the subject matter insured at the time of the loss. Insurable interest is not required to be present at the time of taking the policy. Features of marine insurance. The features of marine insurance are: offer and acceptance. It is a prerequisite to any contract. Similarly, the goods under marine transit insurance will be insured after the offer is accepted by the insurance company. Example, a proposal submitted to the insurance company along with premium on 1st April 2011, but the insurance company accepted the proposal on 15th April 2011. The risk is covered from 15 April 2011 and any loss prior to this date will not be covered under marine insurance. Payment of premium. An owner must ensure that the premium is paid well in advance so that the risk can be covered. If the payment is made through check and it is dishonored, then the coverage of risk will not exist. It is as per Section 64 VB of Insurance Act 1938, payment of premium in advance, details under insurance legislation module. Contract of indemnity. Marine insurance is contract of indemnity and the insurance company is liable only to the extent of actual loss suffered. If there is no loss, there is no liability even if there is operation of insured peril. Example, if the property under marine transit insurance is insured for INR 20 lakhs and during transit it is damaged to the extent of INR 10 lakhs, then the insurance company will not pay more than INR 10 lakhs. Utmost good faith. The owner of goods to be transported must disclose all the relevant information to the insurance company while insuring their goods. The marine policy shall be voidable at the option of the insurer in the event of misrepresentation, misdescription, or non-disclosure of any material information. Example, the nature of goods must be disclosed, that is, whether the goods are hazardous in nature or not, as premium rate will be higher for hazardous goods. Insurable interest. The marine insurance will be valid if the person is having insurable interest at the time of loss. The insurable interest will depend upon the nature of sales contract. Types of marine insurance coverage. Marine insurance is an extremely important element of boat ownership. This offers a wide variety of options for the boat, including cover for physical damage, liability, medical emergency, and other unforeseen circumstances that may occur on the water. Physical damage coverage. This policy guards the boat, motor, and equipment against theft, fire, vandalism, wind, lighting, and other acts of nature. Any official drivers of the boat will be protected if we crash into an underwater banked object. In addition, the boat equipment is covered up to a certain value. We must select between an actual value and agreed value policy to determine exactly how much we will be covered or if the boat should ever sustain damage. Liability coverage. This type of coverage ensures in the event that we or a passenger causes injury to another person or property while on board. If we accidentally collide with another vessel or dock area, we can feel secure knowing we are covered. This coverage usually protects passengers and property up to INR 5 crore. Medical coverage. In the event of a boat accident, this policy gives us and our guests the medical protection we need to save ourselves from incurring astronomical hospital bills. Extensive coverage. There are other items that we may want covered for our boating needs, whether it is towing, personal effects, portable televisions, stereos, cameras, mobile phones and fishing gear, or uninsured boater prevention. Our partner has a plan to meet the needs. There is also additional supporting liability insurance for those adventurous owners who like to race and participate in competitions. Origins of formal marine insurance. Maritime insurance was the earliest well-developed kind of insurance with origins in the Greek and Roman maritime loan. Separate marine insurance contracts were developed in Genoa and other Italian cities in the 14th century and spread to northern Europe. Premiums varied with intuitive estimates of the variable risk from seasons and pirates. The modern origins of marine insurance law in English law were in the Law Merchant, with the establishment in England in 1601 of a specialized chamber of assurance separate from the other courts. Lord Mansfield, Lord Chief Justice, in the mid-18th century began the merging of law merchant and common law principles. The establishment of Lloyd's of London, competitor insurance companies, a developing infrastructure of specialists such as shipbrokers, admiralty, lawyers, bankers, surveyors, loss adjusters, general average adjusters, and the growth of the British Empire gave English law a prominence in this area which it largely maintains and forms the basis of almost all modern practice. The growth of the London insurance market led to the standardization of policies, and judicial precedent further developed marine insurance law. In 1906, the Marine Insurance Act was passed, which codified the common law. It is both an extremely thorough and concise piece of work. Although the title of the Act refers to marine insurance, the general principles have been applied to all non-life insurance. The principle of indemnity in valued marine policies. The principles of insurance law are an idiosyncratic mixture of contract, law and practice. In the context of marine insurance, the contract embodied in the policy of assurance is given prime of place and is fostered by the Marine Insurance Act 1963 and market practice. The parties to the policy, the assured and the insured, are given relative freedom to mold the agreement to their specifications. However, this freedom is not without limitation. Mandatory rules of public policy come into play. These rules serve to bind this freedom and bring a sense of homogeneity to what could otherwise be an extremely varied tapestry of contracts. In insurance practice, overriding public policy concerns against profiteering centered on the prohibition of gaming and wagering, Unlawful Adventure and Fraud Act to curb any policy arrangements which are considered too illicit to be allowed. Marine policy as a contract of indemnity. A contract of marine insurance is a contract whereby the insurer undertakes to indemnify the assured in the manner and to the extent thereby agreed against marine losses, that is to say, losses incident to the marine adventure. Expressly, the contract agreed by the insurer and the assured is one of indemnity. The insurer agrees to provide protection against stipulated losses the assured may incur by reason of being connected to a marine adventure. As consideration for this protection, the assured pays a premium calculated by reference to the nature and degree of risk involved in the adventure. The ultimate objective behind this exchange is to ensure that in the event that a peril for which provision is made causes loss or damage to the subject matter, the assured would be compensated under the policy. In effect, the policy transfers the risk of loss or damage occurring to the subject matter from the assured to the insurer who will bear it should actualize. Historically, the transfer of risk by way of marine insurance policy was vital to the development and preservation of international trade. Did you know the first known marine insurance agreement was executed in Genoa on 1347 and marine insurance was legally regulated in 1369 there. Moving on further, let's talk about essential elements or principles of marine insurance. The marine insurance has the following essential features which are also called fundamental principles of marine insurance. Features of general contract, insurable interest, utmost good faith, doctrine of indemnity, subrogation, warranties, proximate cause, features of general contract, proposal. The broker will prepare a slip upon receipt of instructions to insure from ship owner, merchant or other proposers. Proposal forms, so common in other branches of insurances, are unknown in the marine insurance, and only the slip, so called the original slip, is used for the proposal. The original slip is accompanied with other material information which the broker deems necessary for the purpose. The brokers are expert and well versed in marine insurance law and practice. The various kinds of marine proposals are altogether too diverse, so elaborate rating schedules are not possible and the proposals are considered on individual merits. Acceptance. The original slip is presented to the Lloyd's underwriters or other insurers or to the lead of insurers who initial the slip, and the proposal is formally accepted. But the contract cannot be legally enforced until a policy is issued. Consideration. The premium is determined on assessment of the proposal and is paid at the time of contract. The premium is called consideration to the contract. Issue of policy. Having effected the insurance, the broker will now send his client a cover note advising the terms and conditions on which the insurance has been placed. The broker's cover note is merely an insurance memorandum and naturally has no value in enforcing the contract with the underwriters.
Hi, my name is Ashley Borowski. I do marketing at Lilly & Associates International.
I'm Nelson R. Cabrera. I'm the Manager of Business Development at Lilly & Associates International.
Lilly & Associates is a full-service freight forwarder headquartered in Miami, Florida. We specialize in ocean freight and we have offices all around the world, specifically Guatemala, Colombia, Venezuela, Panama, and most recently China. We get a lot of questions from our importers and exporters on cargo insurance. What does it entail? How much do you need? What's covered? So if you were to give kind of a basic overview of cargo insurance to importers and exporters, what would you tell them?
That's a great point, Ashley. Cargo insurance is very important in the supply chain. The first thing I would say to our importers and exporter friends is don't assume the cargo is insured. Make sure that the insurance coverage is stated in writing. Make sure, I recommend always, to make sure it's door-to-door coverage, because port-to-port coverage really doesn't cover anything. Port-to-port is from a port to the port, to the other port. So basically you're limited to what happens within the ship or the airplane. And usually nothing happens. It's not being transported, it's not in a city, it's not in a highway. So the scope is very limited as to what could happen within the confines of a ship. Now, when the cargo gets unloaded and it goes into the port and it goes into a highway and then to a warehouse, people are driving it, there's a lot of theft out there, whatever city it might be, that's when the likelihood of something happening is at an all-time high. So the second thing I would tell customers is make sure it's a door-to-port coverage. Port-to-port is much cheaper, but it doesn't cover anything. And you should not be paying 1% of the CIF value for the insurance. Make sure that the insurance company is AAA rated and has the ability to pay in case there's a claim.
And that brings us to a great point. What if there is a claim? How does an importer or exporter kind of go about making that claim?
If the first thing you got to do is each insurance company will advise you of where the nearest inspection company is. Don't touch anything. Leave everything as is. Call the inspector immediately. Have them take all the pictures. Preserve all the evidence. Do not throw any boxes away in case of water damage, for example, or the actual goods being damaged. Keep everything on the premises. So when the inspector comes, you provide them with visual proof of the occurrence. As far as the paperwork, well, your packing list, your commercial invoice, your bill of lading, trucker weight bill, release from the port, because that document has how much the goods weighed at the time of being picked up at the port, and the bill of lading also. So they'll be able to do the comparison very quickly if you have all the documents ready. Obviously, the more proactive you are and the more the documents are squared away, the quicker your claim will get paid.
Insurable interest, Section 7, 8 and 9 to 16 provide for insurable interest. An insured person will have insurable interest in the subject matter where he stands in any legal or equitable relation to the subject matter in such a way that he may benefit by the safety or due arrival of insurable property, or may be prejudiced by its loss or by damage thereto or by the detention thereof, or may incur liability in respect thereof. Since marine insurance is frequently affected before the commercial transactions to which they apply are formally completed, it is not essential for the assured to have an insurable interest at the time of effecting insurance, though he should have an expectation of acquiring such an interest. If he fails to acquire insurable interest in due course, he does not become entitled to indemnification. Exceptions. There are two exceptions of the doctrine of indemnity in marine insurance. Profits allowed. Actually, the doctrine says that the market price of the loss should be indemnified and no profit should be permitted, but in marine insurance, a certain profit margin is also permitted. Insured value. The doctrine of indemnity is based on the insurable value, whereas the marine insurance is mostly based on insured value. The purpose of the valuation is to predetermine the worth of insured. Did you know Section 19, 20, 21 and 22 of the Marine Insurance Act 1963 explained doctrine of utmost good faith. Subject matter of marine insurance. The insured may be the owner of the ship, owner of the cargo, or the person interested in freight. In case the ship carrying the cargo sinks, the ship will be lost along with the cargo. The income that the cargo would have generated would also be lost. Based on this, we can classify the marine insurance into four categories. Hull insurance. Hull refers to the ocean-going vessels, ships, trawlers, etc., as well as its machinery. The hull insurance also covers the construction risk when the vessel is under construction. A vessel is exposed to many dangers or risks at sea during the voyage. An insurance effected to indemnify the insured for such losses is known as hull insurance. Cargo insurance. Cargo refers to the goods and commodities carried in the ship from one place to another. The cargo transported from the sea is also subject to manifold risks at the port and during the voyage. Cargo insurance covers the shipper of the goods if the goods are damaged or lost. Freight insurance. Freight refers to the fee received for the carriage of goods in the ship. Usually, the ship owner and the freight receiver are the same person. Freight can be received in two ways, in advance or after the goods reach the destination. In the former case, freight is secure. In the latter, the marine laws say that the freight is payable only when the goods reach the destination port safely. Hence, if the ship is destroyed on the way, the ship owner will lose the freight along with the ship. That is why the ship owners purchase freight insurance policy along with the hull policy. Liability insurance. It is usually written as a separate contract that provides comprehensive liability insurance for property damage or bodily injury to third parties. It is also known as protection and indemnity insurance, which protects the ship owner for damage caused by the ship to docks, cargo, illness or injury to the passengers or crew, and fines and penalties. Assignment of marine policy. A marine insurance policy may be transferred by assignment unless the terms of the policy expressly prohibit the same. The policy may be assigned either before or after loss. The assignment may be made either by endorsement on the policy itself or on a separate document. The insured need not give a notice or information to the insurer or underwriter about assignment. In case of death of the insured, a marine policy is automatically assigned to his heirs. At the time of assignment, the assigner must possess an insurable interest in the subject matter insured. An insured that has parted with or lost interest in the subject matter insured cannot make a valid assignment. After the occurrence of the loss, the policy can be assigned freely to any person. The assigner merely transfers his own right to claim to the assignee. Now, in the end, let us summarize what we have learnt in this lecture. Marine insurance is an extremely important element of boat ownership. Physical damage coverage policy guards the boat, motor and equipment against theft, fire, vandalism, wind, lightning and other acts of nature. Trying to save money by not having marine insurance can cost one a fortune in the event of an accident or damage to one's vessel. The principles of insurance law are an idiosyncratic mixture of contract, law and practice. In the context of marine insurance, a total loss can take one of two forms, either actual total loss or constructive total loss.